Well, good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, where we talk about all things related to the mortgage market as well as the bond market. Of course, as you know, we're kind of springtime. In fact, you might have heard that springtime officially starts right around March 20, March 21 range. Well, that's not true. Spring doesn't really start until today. And why do I say today? Well, today's opening day for Major League Baseball. So, in my opinion, my humble opinion, that's when spring really starts. So, I'm looking forward to that. I'm a big baseball guy, and for those of you who think that baseball is kind of boring, that nothing's going on, I'm going to encourage you to read a book that's pretty out of date now, about 30-year-old book called Men at Work by George Will, the political pundit. He's a big baseball fan as well. And it's a great book. Gets into all kinds of detail about baseball, the game, and how it works. And there's even a quote in there about how with baseball, there's a lot going on out there, even though many people think it's just sort of boring with players just standing around. Baseball is a very unique sport. Consider this. It's the only major sport that doesn't have a time clock. Or consider another factoid, if you will. Baseball is a sport where the defense possesses the ball. And there's many other interesting tidbits about baseball that you'll find very interesting if you read that book. But anyway, I digress. Welcome again to this week's Mortgage Minute. We are in the start of springtime. So let's go ahead and get right into where we're at with mortgage rates and the bond market. Jeff's going to pull up our rate grid from our website. And it continues to, I think, illustrate how we're in a pretty good position where rates are stable, relatively flat. We're still, even now after many weeks, we're still in the low mid sixes, depending on the product type. Conforming conventional loans are hanging on to 6 3/8. FHA, VA loans are right around 5 7/8, 5.99 to 6%. Jumbos are still around mid to low to mid sixes. 15 years still in the just above 5.5 at 5 5/8. So I think, again, this is good news in the sense that rates are very stable. And I think it's starting to have more of an impact on borrowers, and that is both homeowners as well as prospective home buyers. We are seeing more activity on both fronts. So I think on the homeowner side, they're starting to realize rates are what they are. They've been at these levels for quite some time now. They are projected to remain at these levels for literally perhaps the next couple of years. So for those of you who have a lot of equity, you want to access that, I would suggest to you at least start checking around, talk to somebody like us, and let us show you what those options are. On the purchase side, again, these rates have been very stable for quite some time now. We're seeing more buyer activity. And at these levels, you can do some things in terms of negotiating a purchase where you can get some help from the seller and get these rates bought down to the fives, or if you use a temporary buy down, even as low as into the threes the first year. So keep that in mind. This is really a pretty good time to consider buying if you've been holding off for quite some time. And there is more inventory, and there is a little bit more room to negotiate off the initial list price. So keep that in mind. Jeff's going to pull up the chart of the 10-year bond yield. We show this every week. It's a 5-year chart, or 5-day chart. Goes back to last Friday to today. And you can see we've got a little bit of a trend upwards, but nothing crazy. You're basically looking at around 5 1/4 up to about 4.36 today. And it's interesting, last week and actually about 2 weeks ago, the bond yield was getting pretty low, down to about 4.2. Even at one point, it got down to 4.15. As I mentioned in previous programs, that really, I think, had more to do with flow of funds because of the stock market getting jittery with all the tariff and trade war talk that's been happening. And that really didn't move mortgage rates much, even though the bond yield got quite a bit lower, almost 20 beeps lower than it is now. Mortgages really didn't move, which is not terribly uncommon when you have more of a flow of funds situation because the stock market's performing poorly. The money that flows into the bond market is predominantly in the treasury bond market, not mortgage-backed bonds. And so that's why we didn't see much improvement in mortgage rates, even though the 10-year treasury bond yield had dropped. So that's a good example of how the 10-year bond yield is a good barometer, but it's not, it's not a one-to-one relationship to mortgage rates. It's probably the closest in terms of tracking mortgage rates, but there can be some variance from time to time depending on the reason for the drop in the 10-year bond yield. So in terms of what's going on this week as to data points and why we are at where we're at with the bond yields, there's a few things that are going on. This week was a relatively light week on the calendar as far as data points, but a few newsy items to consider. New home sales, they were up slightly in February. And when you kind of peel the onion as to what was going on with those new home sales, there's a recurring theme about home builders are continuing to use incentives, financing incentives to buyers to get those homes sold. So that's how those home sales did increase. There was an uptick in February, in part because of aggressive use of incentives to attract more buyers. And I'll continue to harp on the fact that resale agents ought to take a page out of that book and consider that when you're negotiating an offer for a buyer. Or on the seller side, if you're contemplating a price reduction because you haven't gotten any movement on your sale, on your listing, consider a financing incentive instead of just lowering your price. That can prove to be very effective, as new home builders have shown time and time again. The other thing that came out this week, it's not a data point per se in terms of the bond market, but the Case-Shiller index. Of course, that's a very well-known index now as to home values. And again, it showed in January, home sales, or home values, I should say, up 4.1% on an annual basis in January. That's been a consistent theme. Home prices are continuing to go up, albeit not as quickly as they were. They are going up at a lower rate of increase, but they're still going up. That's despite existing high home prices and these, extremely quote unquote high mortgage rates. That hasn't dampened home values to the point where they're dropping, at least overall in the market. Remember, the Case-Shiller index, there's both a 10-city and a 20-city index. The number I have up here is based on the 20-city index, so it's a pretty broad national number. And the bottom line point here is, if you've been waiting to buy a home because you think prices are going to fall or because you want to see rates fall further, you're missing out. You should jump into the home buying process if you've been waiting, because home prices are projected to continue to go up. The other thing that came out this week, consumer confidence, the media jumped on it, 4-year low, and that portends to some bad news in the future, potentially about the economy. I wouldn't put that much weight on it. As I put on the slide here, most of that confidence is shaken by tariffs and trade war headlines. And remember what we say in the show about beware the headlines. The headlines have been very negative about the tariffs, the trade wars, quote unquote, that are occurring. I think that's all going to blow over. So I think this consumer confidence number is something to not get terribly concerned about. I think it's a little bit of a flash in the pan as to this tariff and trade war headline activity. And I think once things settle down, then I think that confidence will come back. Really, the most important data point this week is actually not till tomorrow. The PCE, the Personal Consumption Expenditures Index, remember that's the Fed's favorite inflation target. So that comes out tomorrow. That can be a market mover as far as bond yields and mortgage rates. The PCE for tomorrow is projected to be flat. So if that turns out to be the case, or it gets a slightly better, maybe a tick or two better, that should help us on the bond yields and mortgage rates. So keep an eye on that. If you want, just pull up the 10-year bond yield chart tomorrow morning after the PCE has been announced, and you can see what's going to be happening to that bond yield after the announcement. So that's what we have for this week in terms of the mortgage and bond market. I'm going to bring Jeff back in because we're going to talk about an interesting subject that's been in the news, and it's a little bit of a complicated subject for consumers, and that has to do with Fannie Mae and Freddie Mac and the possibility of ending the conservatorship of Fannie Mae and Freddie Mac by the U.S. federal government.
Hey, Art.
Hi, Jeff. How are you?
Good. I there for a second I thought, am I on the wrong show? We're talking a lot about baseball here.
Yeah, you thought you were on the MLB channel, right?
Yeah, I thought I struck out. When's Stephen A. going to come on here? And we're going to talk about baseball.
Yeah, I always get a little excited this time of year because it is opening day, and I'm a baseball fan. Although I'm a miserable baseball fan because my team are the Angels, which of course are been struggling for several years. So.
Well, I have a question about this official opening day. Wasn't there a game played in Tokyo, and that was kind of the opening day? But really, isn't this the opening day? What is that all about?
Yeah, that was kind of weird. I have to agree. I mean, it was actually last week. I guess the official opening day for Major League Baseball was because the Dodgers played in Japan. There was, I think, 2 games in Japan last week, which of course you can imagine why that was set up. The Dodgers have Shohei Ohtani. He used to be on my Angels. Of course, that was disappointing to see him go, but I understand why. So when you consider MLB wanting to get some attention from the Japanese market, it made sense for them to have a couple of games in Japan. So yeah, that's technically the start of the baseball season, but really today's the start. There's, I think, 14 games scheduled throughout the country. So this is really when things get going. So
the other thing I want to ask you about, I know last week you were in someplace in Nevada. We won't disclose that, but you were watching the kickoff to the March Madness. What was that like?
Well, I'll disclose it. I was in Laughlin, Nevada.
Okay.
Yeah, that's an interesting trip, actually. I got involved in it about 15 years ago. There's this group of, I call us old guys. There's about 50 of us. And every year, this group in recent years goes to Laughlin for the opening week of March Madness. So typically most of the guys get there on Tuesday. I got there Wednesday, and it goes through the end of the week. And we've got set up some golf outings. We even do a bowling tournament, and then in between, we're in the sports book watching the basketball games and placing bets on the college tournament. And they've been doing this now for 29 years. And they first started doing it in Las Vegas. And of course, again, about 15 years ago, they moved to Laughlin, just frankly, because Vegas got to be too expensive. But it's a fun trip. And it's actually gotten me much more involved in college basketball. I was never really in tune with that too much. But now that I've been involved with this group, it's something I'm very interested in, particularly during the tournament, which, of course, the next round of games, I think, are tomorrow, the Sweet 16. So
I guess there were some upsets, I guess you'd say. Were you watching those? Did you have much action on that?
Upsets. Yeah, there was a few upsets this year, although I would argue not as many as in past years. I think a lot of the favorite teams are still in it, and of course, I've got a bracket like everybody else, and I'm doing reasonably well on my bracket so far. And I do have, in case anybody's curious, I do have Duke to win it all. So.
Well, they've been known to win a few championships in the past.
So I've heard.
Hey, I want to talk to you about this conservatorship, this whole thing about Freddie Mac and Fannie Mae. And I thought, hey, before we start, because I think it is a hot topic, the first question is, who is Fannie Mae and Freddie Mac, and what do they do?
Yeah, it's a really good question. So I'm going to give you a little bit of a history lesson on that. Fannie Mae is Federal National Mortgage Association. Freddie Mac is the Federal Home Loan Mortgage Corporation. Now, these today are considered quasi-federal agencies, but they were both created quite a long time ago. Fannie Mae, in fact, that agency was created in 1938 by the Roosevelt administration. And the reason Fannie Mae was created was to add more liquidity to the mortgage market during that period. You might also recall, or maybe you don't know, FHA was actually created in 1934. And FHA, the purpose of FHA was to insure lenders against default in order to induce lenders at that time to offer mortgage loan financing on more favorable terms. Because back in those days, before the creation of FHA, if you wanted to buy a house and get a loan, you had to provide a very big down payment, typically 50% of the value of the property, and the term of the loan was relatively short, maybe 5 years. And those are pretty onerous terms for many people in the country at that time to be able to finance the purchase. So FHA was created to induce a lender to extend the loan term out to as much as 30 years and allow a much lower down payment, with the guarantee that if the borrower defaulted, which is more likely because of less down payment, that the lender could file a claim with FHA and get reimbursed for their foreclosure loss. Then in 1938, Fannie Mae was created And the purpose of Fannie Mae, which is unusual compared to what they do today, was to buy FHA, VA, and USDA loans from lenders. And then that would allow lenders with the proceeds to make more FHA, VA, and USDA loans. So that's where it added more liquidity to the market. And then what happened was in 1968, the federal government created the Government National Mortgage Association, also known as Ginnie Mae. And what that did is it split up Fannie Mae into basically, it split it in two, basically. Ginnie Mae would at that point, they guarantee the FHA, VA, and USDA loans for the benefit of the lenders, and they would accumulate these loans and pool them to create mortgage-backed securities to sell in the financial markets. And again, those proceeds allowed lenders more liquidity to make more of the government-insured or guaranteed loans. Fannie Mae then in '68, having been split off from that part of their initial mission, then going forward from 1968, buys non-government insured or guaranteed mortgages, aka conventional loans, and that's what Fannie Mae's been doing since 1968, is buying conventional loans, non-insured or guaranteed federal type loans. Freddie Mac was created in 1970, so it's a relatively younger agency, again created by government charter. And Freddie Mac was created, frankly, solely for the purpose of creating more competition on the conventional loan side to compete with Fannie Mae. So that way you would have two quasi-federal agencies both buying conventional loans from lenders, again, with the mission to create more liquidity. And of course, by having that competition, that helped in terms of what kind of rates could be offered for those type of loans. So that's where Fannie Mae and Freddie Mac, how they originated and how they've established what they do today.
I think a lot of people are. First of all, there's a great explanation of both of those entities. I think a lot of people would be, really, if they had to guess, and there was a list of 5 dates on there of when they originated, they would have no idea they went back that far. I think that's pretty amazing.
Yeah.
I'm curious. So now, and this is another one of those. I bet they didn't know this. Are these then government agencies? In other words, are they under the house of the government, or are they out on their own?
No, Fannie Mae and Freddie Mac are not, government agencies per se. They are not wholly owned by the federal government. That's unlike Ginnie Mae, by the way. The Government National Mortgage Association, also known as Ginnie Mae, is wholly owned by the federal government. Fannie Mae and Freddie Mac, no. They are government-sponsored enterprises. They were created by the federal government at the times I noted, but they are not outright owned by the federal government. So that's why we refer to them as quasi-federal agencies, because of the fact that they are not outright owned by the federal government.
Well, the next question is this whole idea of conservatorship. When did it actually get placed under conservatorship? Because if it's a quasi government agency, it seems like, was it because they're too big to fail? What's the deal on that?
Well, exactly right. And the conservatorship with Fannie Mae and Freddie Mac, and boy, that's a hard word to say. I get tongue-tied all the time when I try to say that, conservatorship. But what happened is, and this is going to make sense to a lot of people once I explain it, that status happened in 2008, at the mortgage and real estate crash, the Great Depression, as we call it. Fannie Mae and Freddie Mac were in trouble. They were in serious trouble. And in terms of just remaining solvent. And that would have created a disaster in the entire U.S. housing market industry that the federal government simply could not allow to happen. And so in 2008, as a result of the Great Depression, the feds stepped in and placed both agencies under the conservatorship of the Federal Housing Finance Agency, or FHFA. And the way that was set up is that the government actually got some sort of preferred stock, senior stock, as part of the deal. And so as a consequence, and the other thing that did is it created this implicit, not explicit, this implicit guarantee that if there were going to be any more difficulties, financial difficulties with either agency, that the federal government would step in to address that, to cure that financial distress. And so essentially, this arrangement that we've had ever since was as a result of the federal government stepping in to save both agencies. And that's, again, how it's been ever since. And that is the issue that's now being talked about, as to whether or not that conservatorship of these two agencies by the feds, by the FHFA, if that should continue or not.
Curious, as you talk about that period of time in 2008, and then the government stepping in, and really they were too big to fail. Couldn't, like you said, it would have been a disaster that I don't think any of us wanted to experience. Does that mean that the government has a little bit of control when it comes to kind of tilting the scales of what they do and what they buy?
Well, to some degree. I mean, they still fully buy conventional, non-insured guaranteed loans, conventional loans from lenders. They still do that. That's their core mission. The FHFA closely monitors and regulates those two agencies. And that actually has been helpful because, again, it creates at least this impression of implicit guarantee by the Fed. So in other words, 2008 was an example of how, yes, too big to fail, the government stepped in and essentially bailed out the two agencies. And the status that they've had ever since with this conservatorship is to maintain that oversight of those two agencies. And because of that, that has helped keep mortgage rates. Now, I know everyone thinks rates are too high right now, but without that conservatorship, rates would be even worse, because you wouldn't have this implicit guarantee that the market observes that helps establish the rates where they're at now and keeping them lower than they otherwise would be. So it's turned out to be a pretty beneficial thing. And so again, it kind of creates the issue of why are they talking about now maybe ending it, and that's what we can get into a little bit more. So,
well, you mentioned implicit and explicit. So first of all, what does it mean when it comes to those two agencies, and what's the difference?
Well, implicit, as I've mentioned a couple of times now, what that does, an implicit guarantee by the Fed simply means, the Fed doesn't outright own Fannie Mae and Freddie Mac. They're not wholly owned government agencies. Yet it's implied that the federal government will step in case of financial distress or possible failure of either agency. And that's important because in the secondary market, where investors buy mortgage-backed securities, which are securities that are collateralized by pools of mortgages, and in the case of an MBS, a private MBS, that again means loans that are not government insured or guaranteed. When a private MBS is issued by Fannie Mae or Freddie Mac, that implicit guarantee that the Fed will keep an eye on those two agencies and make sure that they do not fail financially, that helps maintain or allow for a lower yield to be offered on those securities when they're sold in the secondary market to investors all over the world. And that implicit guarantee helps keep that yield lower. And that, of course, the result is the mortgage rate on those loans that are collateralized in those pools is going to be a little bit better than if there was no guarantee at all. Explicit is more direct. That's where an explicit guarantee is the agency outright is owned by the government. So you have the full faith and credit of the federal government behind that agency. And in that case, the securities, the mortgage-backed securities that they sell in the financial markets. And Ginnie Mae is a good example of that. Fully owned by the federal government. Ginnie Mae pools, FHA, VA, USDA loans. And then they, with those pools of loans, they create Ginnie Mae securities that they sell in the financial markets throughout the world, and of course can sell to entities, including the Federal Reserve. The Federal Reserve can buy those because they have the full explicit guarantee of the federal government. If that explicit guarantee wasn't there, the Fed would not be able to buy those kind of securities, which of course, if that weren't happening, then the rates on the underlying loans for those securities would have to be higher to account for the additional risk of not having that explicit guarantee.
And again, forgive me, but this seems like a good point to ask a question. So if it's explicit, let's use Ginnie Mae, does that mean it's not tied to the 10-year?
That's correct. Remember that the 10-year bond that I harp on all the time, it's a benchmark or barometer. There's not a one-to-one relationship between the 10-year Treasury bond and, let's say, a Ginnie Mae mortgage-backed bond. Those are two different instruments. They're both bonds, but they're not identical in terms of what kind of yield they offer. A good example of where you can see this difference between explicit guarantee for mortgages that are pooled into securities and implicit guarantee on mortgages that are pooled for securities as well, where you can see the difference in rate on those underlying mortgages is comparing FHA to conventional. Again, conventional simply means not insured by the government, not guaranteed by the government, but these loans are typically sold to Fannie Mae and Freddie Mac. In almost any scenario, an FHA loan, VA loan, you're going to see a rate that's probably going to be somewhere around 0.5% or more better than a conventional a conventional Fannie Mae or Freddie Mac loan. The reason for that rate spread is in very large part the implicit guarantee, that's Fannie Mae, Freddie Mac, and the explicit guarantee, that's FHA, VA, and USDA. The explicit guarantee, of course, lowers risk to the end investors who buy those bonds because it guarantees that they'll still get the payment of the yield, the interest yield to them, even if the underlying borrowers stop making their payments. That's the explicit guarantee, which is why FHA and VA loans have a better rate than the conventional Fannie Mae and Freddie Mac loans. So that's probably the most direct example of the difference that you can see between an implicit guarantee on a mortgage and an explicit guarantee on a mortgage.
I think that probably helps a lot of our viewers who every week see that the FHA loans are always less expensive than the conventional. And now that makes more sense because, as you say, the government explicit guarantee on those, it lowers the risk of the lender, right?
Well, exactly, because again, an FHA loan is insured by the federal government. And of course, that's what allowed, going back to the 30s, that's what allowed lenders or motivated lenders to be willing to accept much lower down payment. FHA, as you all know or should know, 3.5% down is all you have to make. And the term of the loan was extended out 30 years when back then it was maybe 5 or 10 years. Now, by lowering the down payment that much, the rate of default probabilities go way up. So that's where the FHA insurance comes in, because the lender now has the comfort of knowing, all right, we'll make that loan to that borrower in 1938 with a 3.5% down payment, but we're comfortable doing that because now we know that if they fail to make the payment, we have to foreclose. We can then submit a claim to FHA and get reimbursed for our foreclosure loss. So that's a very direct example of why the FHA loan has a better rate than a conventional loan, because of that explicit guarantee that the lender is protected in case of default.
Well, let's talk about that word that you like to say, conservatorship. Why is that now? Here it is. You said back in 2008, we're talking 16, 17 years later. Is there something that's happened that said, hey, maybe we want to change that?
Well, I think in part the dialogue about it now is, I think a lot of it may have to do with just the current administration. We've got a new president, well, not new, I guess, a returning president, we'll call him, an administration that I think is kind of perceived as being more market oriented, free market oriented, capitalist kind of administration, and we do see some indications that they're looking at privatizing some things, and so part of that I think has caused bringing in Fannie Mae and Freddie Mac as part of that discussion. Is it really necessary for the federal government to continue this oversight of the two agencies through the FHFA, or is it now time to kind of cut the cord and let those two agencies fully stand on their own? Now, keep in mind, these are agencies, Fannie Mae and Freddie Mac, who are publicly traded. They are corporations, essentially private corporations. You can buy stock in them, but they still have this very close oversight by the feds. So I think just the general idea discussion with the current administration of looking to create more government efficiency and privatize some of the things the government does, I think this has gotten thrown into the dialogue. And it's interesting because the conservatorship of Fannie Mae and Freddie Mac at the time, of course, was considered to be a temporary move. But that reminds me of back then when, right after the Great Depression, the jumbo mortgage market froze up. There was an instant lack of liquidity, and jumbo financing got very scarce and hard to find, at least at a reasonable rate. And so Fannie and Freddie at the time stepped in and came up with a new category of conforming loans called agency high balance or agency jumbo. So what the two agencies did is they jumped in and said, okay, the jumbo market, the private jumbo market is now illiquid. So we need to step in and create another option for buyers of more expensive homes to be able to finance them when the jumbo market has at least temporarily disappeared. So they came up with this new category of higher loan amounts that they would buy from lenders. And the higher loan amount would vary by county depending on the median price of homes in that county. And again, this agency jumbo or agency high balance category was initially intended to be temporary. Well, here we are 16 years later, and it's almost 17 years later, and that category is still there and probably always will be going forward. So that's really what's going on in terms of that discussion now about ending the conservatorship and taking both agencies back to being fully private.
Well, I want you to kind of walk us through the possible scenarios that could come along. I think the first, and also to let us know, hey, if this scenario plays out, is it a positive or negative for, let's say, the borrowers who would say, well, they'll have higher interest rates? Would there be no change? Would there be lower interest rates? What are those kind of things? To me, it sounds like almost if the government gave us an explicit on those, then we might see lower rates, but not significant, not enough to 1 or 2 points. But if you would, let's walk us through that one, if you will.
Okay, sure. Yeah, in fact, there was actually the economist from Moody's, a guy named Mark Zandi, has studied this topic quite a bit, Fannie, Freddie, and the government's role with both agencies. And so he has actually come up with multiple scenarios involving the conservatorship of Fannie Mae and Freddie Mac. And he actually came up with 5 different scenarios. The first one was just keeping the status quo. And if that's the case, of course, he would argue, and I would agree with him, there would be no change in the current mortgage interest rate levels. It would just more of the same, business as usual, maintain the status quo, no change. And he actually rates that as a pretty high probability of what's going to happen with all this discussion. In fact, he calls this probably about a 65% probability. And I would tend to agree with him. So I think from that perspective, for anyone who's watching or listening to our show today, and if you've seen these headlines about the discussion of maybe pulling the plug on FHFA oversight of Fannie Mae and Freddie Mac, I would argue that don't read too much into that. I think that it's likely that we're probably not going to see that. Again, Mark Zandi at Moody's is suggesting probably a 65% chance that we'll just be business as usual. Now, the next scenario that he discussed was having Fannie Mae, Freddie Mac unleashed from oversight, unleashed from the conservatorship, by FHFA, but maintaining the implicit government guarantee. Now, that is interesting because in part you would think, well, that shouldn't change anything from what we have now. And the reason you might think that is, well, prior to '08, which you see there on the bottom of the screen, Fannie and Freddie were not under oversight by the federal government. And so you think, well, back then, so things weren't bad or terrible or anything back then. So why wouldn't releasing them from that oversight now, but maintaining that implicit guarantee, why wouldn't that be a good thing? Because after all, we already have an example of where the implicit guarantee came to be in 2008 when both agencies almost collapsed and the government stepped in and bailed them out. Well, the problem with this scenario, which I think Mark Zandi at Moody's suggests this is about a 20% probability, is that while you would think this wouldn't cause any change, some investors of Fannie Mae, Freddie Mac mortgage-backed securities may still consider this more risky because of the ending of the government oversight. So his projection would be, if this scenario played out, you would probably see about a 20 to 40 basis point increase in mortgage rates, if not because of local or national investors, but international overseas investors might consider the lack of government oversight to be a risk feature that would require higher rates in order to take that into account. Now, the next potential scenario would be for Fannie Mae, Freddie Mac to be released from government oversight entirely and have no implicit or explicit government guarantee at all. They would be fully independent private agencies with no direct oversight through conservatorship, standalone publicly traded companies, and no implicit guarantee the government would step in to save them again, and certainly no explicit government guarantee because they're not owned by the government under that scenario. Now, Zandi calls this a 10% probability, and I would tend to agree with him. And part of the problem with this is that this would mean that government-sponsored enterprises like the Fed couldn't buy the loans at all without one of these guarantees. There would be more FHA loans made, and part of the reason for that is this scenario would greatly increase conventional rates, probably by 60 to 90 basis points. With that much of an increase on Fannie Mae, Freddie Mac conventional loans in rates, increase in rates, that would widen that spread, that disparity between conventional loan rates and FHA. It would cause a lot more loan volume to happen on the FHA side because of the lower rates. The problem with that is that's much more exposure to U.S. taxpayers because the FHA loans are fully part of the federal government. They do have explicit federal government guarantee, and so that exposes U.S. taxpayers because, of course, FHA loans do have higher default rates because of the lower down payments. And so Zandi considers this only a 10% probability because of those risk factors. Then the next one is release Fannie and Freddie from government oversight, no conservatorship, but maintain an explicit government guarantee. Now, if that were to happen, he suggests rates would probably go down about 25 basis points or 0.25% from where they are now. But he would argue that the probability of that's about 5%. And I would agree. Why? Because you'd have to get legislation to make that happen. And the Congress has got a whole lot of things on its plate, a lot of issues in terms of, the number of votes you'd have to get to make this kind of change. So he considered this a long shot by far, and I would have to tend to agree with him. I don't think the current environment would support the idea the federal government would fully step in and provide an explicit guarantee to both of those agencies. And then the last one scenario that he suggested could happen is that Fannie and Freddie would be fully chartered as a government corporation, just like FHA or just like Ginnie Mae. Of course, that would provide the lowest possible rates for conventional loans. But again, the argument there is like zero chance it's going to happen. Again, why? Because that would require legislation. And the current environment with, the Doge scenario and so forth, Do you really think that the Congress is going to make any move toward taking Fannie and Freddie and making them fully 100% part of the federal government? I don't think so. That's like a zero chance. Mark Zandi at Moody's calls that a zero chance. So I think all in all, despite the headlines, despite all the news, I would say relax, stay calm. We're probably looking at things just staying the same. And I think for now, given our overall challenges with the housing market and the interest rate market, that's probably a good thing. Let's keep things stable. Let's not, rock the boat, if you will. And I think that's what's going to happen.
Well, I think that was a great explanation, and it makes sense that the probabilities just kept going down. It's like we have a 17 or 16 or 17-year marriage going on, if you will, or a courtship. Why screw it up? Let's just let's keep going the way because here's the thing that in my mind is it keeps the risk where it should be, and it allowed, if I'm not mistaken, when these government agencies or quasi agencies came on board, it was because the banks, your local banks, could only carry so much debt. Isn't that correct? And so them able to sell the loans outside their bank, as you said, it gave them more liquidity to continue to serve their local customers.
Exactly right. I mean, these agencies were created specifically to address liquidity in the U.S. mortgage market, which, of course, the ultimate mission of doing that, more home ownership. And of course, consider when FHA and Fannie Mae were created in the 30s during the Great Depression. And of course, the economy was on its rear. And so it was part of the Roosevelt administration's strategies to, attack the problems with the economy at the time, get us out of that depression. And a good way to do that was to provide the right structure and parameters to allow a significant growth in home ownership. And it succeeded. I've called FHA probably the greatest mortgage program the U.S. government has ever created, and I continue to believe that today. It is a great, great loan option that I think even today is a little bit underutilized by a lot of borrowers.
I was going to ask you what, knowing this and knowing that FHA traditionally has a little lower rate, is it about a 50-50 or is it much higher than FHA versus conventional mortgages?
Well, again, the typical spread between an FHA and conventional loan will generally be somewhere around 0.5%. FHA is going to be better by that amount. And that spread can get even better for borrowers at the lower credit score range. For borrowers who are in the 600s, 660, 640, 620, that spread between a conventional rate and an FHA rate gets even wider because FHA doesn't punish the borrower nearly as much for lower credit score as Fannie Mae and Freddie Mac do. And so that's why whenever I'm encountering a borrower, a home buyer who wants to be pre-qualified to buy a home and they have minimal down payment, which if you haven't heard is pretty common, they only have 3.5% or 5% down, maybe 10% down, but then we learn that their credit score is 630. I'm going to be all over the idea of presenting them. Yes, I'll give them the conventional loan option, but I'm going to give them FHA. And what they're going to see is a substantial difference in the terms where FHA is going to be a much, much better option for them given their current situation, in particular their credit score.
Well, this could certainly become a very heady, complicated situation. I think you made it much simpler to say, especially when we're talking about implicit, explicit. Okay, I get that now. And if you have more questions about this, as you can tell, Art is very well versed on that. I'm just going to pop your information along the bottom there. You can always get a hold of Art at 760-969-5023. That's his cell phone. And of course, you want to go to the website where you saw early on, where you could check the rates and you really want to take that thing about more about the loans. He has a nice video in there explaining how that all goes together. So, Art, thank you today. I really appreciate it. I think you did a great job of shoring up this headline that, you never know. It's like, hey, it could be a good thing, could be a bad thing. Maybe we got to just stay right where we're at. So I really appreciate it.
You're welcome, Jeff. Thank you. All right. Thank you, everyone, for watching and listening to this week's Mortgage Minute. Hope you have a great weekend. And if you can, take in a ball game. It's the start of Major League Baseball, opening day today. Looking forward to the season. So again, thank you for watching and listening. Looking forward to seeing you next week on this on the Mortgage Minute. In the meantime, my name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care.